Hello, today is Sunday, the 5th of June, 2011, and welcome to the Silver Log. We'll start off within the longer term and then go short term and then move back again to the long term time frame. This quarterly chart representing 3 months worth of data. And I've said this many times, just the fact of still being below where we were in the 1980s is enough to at least question and say, well, why is this to be the case? That the retracement was from 50 down to 3.5, and well, that's more than a 90% drop. Yet we hear Ben Bernanke stating, well, this inflation is from the rise in silver and gold prices, and this there proves it incorrect because I didn't see prices at the hockey games go from $10 a ticket down to $1 a ticket. No, they went to $100 a ticket. So the inflation has been here. Overall, silver does not measure inflation when it's not a free market. And obviously it hasn't been. It's been paper traded for quite some time. And overall, what's happening, I just want to do one quick thing before we go to the other charts because we're pretty much going to go back to this. Pretty much. And that is the break above this trend line. You could even raise it a little bit so that's finding support. But the bottom line is to find previous support where you once encountered resistance. Overall, that's a really strong pattern to see. And we can see just by connecting these two resistance points, that's exactly what's been the case. Now let's move on to the shorter term time frame. And on this hourly chart, it was interesting because on the blog on for Thursday, I think, for Friday, one of those days, I think it was one of them. Anyway, I was stating that, yes, it was Thursday, the part two. I was saying maybe we sell off just a little more after the market made this bottom. And that was only because very often these Fibonacci levels tend to meet at significant areas. And now it's came back up to this level. 1 day moving average is about as flat as you're going to get. It could be or making that of this inverted head and shoulders pattern. There's a couple key trend lines, one that has been broken, one that hasn't been tested. This is the one that has not been tested, and the one that's been broken is this one in here. This doesn't mean the trend is changing. However, if it can make a higher low, realistically up even towards this level here, somewhere in this level, and then start to get past this 3650, it increases the chances of taking it out. But the market's been down for quite some time, and really this market did find a level that it really needs to hold, and that's in the 35 level. The volatility for this market's getting so much larger. We'll look at that in a second, but before we do, the rest of the charts are going to be within this form: 50 candles, automatic Fibonacci over 67 periods, the 18-period average of highs, lows, and closes, as well as what's similar to that of Bollinger Bands, really showing oversold or overbought market conditions. And on the same hourly chart, as is the 1 day moving average, so is I guess the 18-hour, very similar levels. But what we could notice within this is how it's able to find support and lift off. Because when you're in a downtrend like this, the market's it's bearish, and then it goes into a cautious level when you're coming to find this level of support, because the the status of the markets, if it's bullish, it's either going to be bullish as it is regular, maybe really bullish, maybe it's newly bullish. And if it starts to make this pattern of higher highs, that will be the case there, as well as cautiously bullish, which is when you come back to an area where you should find support, which is why you're cautious, because you don't know if you will or not. Same thing with the bearish. You're either really bearish, you're newly bearish, or cautiously, and you can either be neutral, neutral with an up bias, neutral with a down bias. Because it's finding support here, I would call this market neutral within that of an up bias. And the volatility for this market is, well, as I've been stating, this 2% level, this is the average moves per hour over a 2-day period. That's what the blue line represents. The orange line represents the average over 10. This is setting the bar. I do expect times to get extremely wild within this financial crisis. Really, this is the point that things are starting to heat up, and at some point it's most likely going to go higher. But for now, I'm seeing what might give us the inverted head and shoulders pattern, but we're 2/3 of the way there. There's no guarantee that's going to happen. Maybe it comes down and starts to make the right shoulder and just keeps going down, or it makes the right shoulder and then goes down something in that area, or maybe it just keeps on going higher. Most of the times when the volatility is really a higher level, which is really anything above 1%, then that does favor the downside. There will be times, most likely, if you have a COMEX default, anything of that nature, and you have quick moves where the market goes up 20% in a day, those types of moves, then obviously this will get out of hand. But there most likely is more of those moves to the downside. Now let's look at this on different time frames. A 6-hour chart, each candle representing 1/4 of a day, and finding support at this level, really a neutral market. And this is the level. Okay, is it getting bullish? Yep. And this is a candle representing that you are now newly bullish. If you're waiting for it to come back to find support, then this is where it came back to after it already hit the upper band. And when it came back down towards this level in here, it did not find support, breaking down below, now finding support in here, thus changing this trend to that of a bear market. The next chart is the weekly chart. And the 18-month averages were really tight. Markets weren't so volatile about a year ago, almost a year ago. And then it was in an uptrend. Here's an area where it's looking neutral with an up bias. Now it's newly bullish, and the market kept going higher. It hugged along within this band. It never was able to really get above it, at least definitely hold above it, but it stayed within it for a good 2, 3, at least a couple months, because I'm seeing 8, 9 candles where it's holding above it. Comes back down to this 18-period average at the start of this year. And as it's bouncing off, there's a nice little breakout candle, and it moves right up towards this area. It did hug it on a few occasions, and then it managed to break above it. When you're seeing these types of actions, to me, this is either pointing out the serious topping actions, and again, just showing this, just hugging the line along the way, but the parabolic moves would also occur within that time frame. The break of the 50 level didn't happen, but that was, of course, the level to look for when this occurred. Rather, now it's came back down to this 18-period average of highs, lows, and closes. It's been staying within it now for a month. The market is not neutral because this band is in an upward trend. If the band goes sideways, at least for a couple of weeks anyway, then staying within it would make it neutral. It's still cautiously bullish. And you're really looking for a break of either one side or another. But oftentimes within these bull markets, you find support at the key areas. And this would definitely clarify with a key area, especially how it came and found support here at the Fibonacci level at 32.52. Next chart. This is a yearly chart. Each tick representing about 365 calendar days, depending on the year, of course. And this little bit in the early part, don't know if it traded at all. From what I see, it looks like it was $1.29 the entire 4 years. Regardless, it doesn't change these levels too much. But back in the 1970s, what was interesting was how it managed at this point to be at the top of this band, meaning it was already bullish and consolidating. Broke above it here in the mid 1960s, and this is only breaking in the $1.50 range. Is unable to hold above it, but comes back down to the 18-period average of everything. Then it comes up to this level, gets above it, closes above it. Then you have another move where it closes above it for 3 candles, really 4, just hugging this line, and boom, it breaks out large. So the Bollinger Bands or any of these types of things, they're designed so that you usually stay below them, but that's because when you have these big moves, these things will stretch out pretty far. And on the way down, it managed that this level would go to a declining period, and within this period average of here as well as these bands, the movements didn't they got smaller. The reason why is because the market got less volatile. In my views, this is just a personal belief, and the market was in this time frame in here. They had to keep the volatility really low because they really couldn't make the market go any lower. It was already at a fire sale price as it was, and they didn't want the market to go much higher because people would be seeing, oh, silver just broke this big $6 level, say back in here, whatever, in that level, and they didn't want people knowing about the price of silver. That's why I'm thinking it was within this manner, but since it's broken out of this level, it's gotten above the 18 in here, showing confirmation pretty much in this level here. Finds resistance at this band for 4 levels: 2006, 7, 8, and 9. It breaks above it in 2010. It's went further to the upside. It's now came back down to this level, looking as if it wants to use support there, which is, to be honest with you, is quite a massive bullish sign, to say the least. Sort of like it was the same sort of pattern here, hugging this line for quite some time and then just moving huge to the upside. Now, as far as these Fibonacci levels, if we look at where they are now, they are in significant places because they just seem to always line up where significant resistance and support happens to be. Can't say why, it just does it way more than random, basically. Therefore, the support was found at this 61.8% on the way down, and this level is at a big level. $10 silver is pretty massive. This level is 969. In that area is really massive because on the way down, this is where it stabilized. This is where it tried to, in 1987, get a break above and wasn't able to. It got above this level and here, found support in 2008. So it's a very big level. And on any big gains, a lot of times tops and bottoms can be close to getting a level picked simply by making an educated guess where these lines are going to meet up. Therefore, on a big breakout above this line, my prediction is this Fibonacci level would meet up with this level. If that was to happen, my question is, where would this level move up to? What price in silver would it go up to the upside to? And the second one is, what would the price of silver actually be? The answer is this one moving up to here would make this one move up to 50, and the market would be somewhere around $630 per ounce. Now, normally when you're looking at these charts, you're thinking, okay, the move is going to come within there in the next 20 or 25 candles. Really 5 to 20, you'd be thinking, 5 to 25, which is 5 to 25 years. And maybe 5 is the year, but however, we do have a little thing called the Mayan calendar getting in the way. And if that's the case, things can get explosive right now. But when you're looking at a chart like this, trying to gauge future levels, because you're using the most longest of term time frames, you're going to get the most larger numbers for the up and down side, sort of like how this lower band here is at $2.83. Question is, when will it happen? That's tough to determine, but silver has been going up on an inflationary basis, and that's why these bands are moving the way they are. That's why this is never being tested. And Well, I can compare this, or at least I can take a look at the same format with a different yearly chart, and I'll do that. That would be the Dow Jones Industrials. Same sort of methodologies. And coming in here, this market starts in a bull market because you have a rising period of averages. In the 70s, you find support there for about 8 years. You break above, and look at how it's messing with this band here. 1, 2, 3, 4, 5, 6, about 8, almost a decade of resistance. And then 1, 2, 3, 4, 5, really 6, 7 candles where it goes above it. Extremely nice. Comes back down, finds support in 2008 and 2009 within the 18-period average. This is more explosive than the silver market has been. And it's not that the stock market's going higher, or it's not that it's that amazing of a play over the last 50 years, but that in the area of inflation. Thank you for watching, and have yourself a magnificent day. Bye-bye.